Hi guys, welcome to How and Travel. I hope you guys are having a great day. So today is going to be a different video. So today I'm going to show you guys how the equity finance, how the financial statements actually work, and how you can connect this to your maybe your finance, personal finance, or your business finance, or if you are an MBA student or finance student. This will help you really understand. I'm going to use the same concept, the same idea, and I'm going to explain you guys the financial statements or the equity, sorry, debt financing or the equity financing, the structure in a more understandable way. I think this will clear most of your doubts if you have any doubts in debt financing or borrowing or financial structures. So let me get started. So before we begin, let's make an assumption that we have two companies, right? One is company A and company B. We have two companies, right? Let me color this in yellow and make it bold and underline it. Simple. So we have two companies, and we also have equity here. Let me tell you guys what's equity in a while. And we got debt is simple borrowing, right? Debt. So let me explain you what are these two, right? If you are not a finance person, you are not familiar with these two words, right? Equity is something like, let's say you want to start a business. So if you want to start a business, you can either borrow money from your friend, or you can go to a bank. That's called borrowing. That comes under debt financing. So that's a debt financing to start a business. Equity financing is where you invest money, your own money, into your business, or maybe you and your friend invest money into your business, put capital into your business in exchange for shares or profits. So that's equity financing. It's your money or the shareholders' money or your partner's money. It's not a debt, right? So there's two ways: you can borrow, debt financing, or equity financing. You can put in your own money or shareholders' money, right? So two different sources of finance. So let's see how these two companies are funded. Company A doesn't like debt, so they don't borrow. They got money, which is very good. 500 million. They got 500 million. That's a lot of money. I wish I have that much of money so I can just enjoy for the rest of my life. Okay, so we got zero debt. We are not borrowing from anyone. I got 500 equity. That's my money or my friend's money. It's just company's money. We don't owe to anyone. So that's 500 million there, right? And company B doesn't have much money, so they got about 250 million of their own money, maybe equity in the company. Simple to understand. And also they went for a borrowing as well. They went for a 250 million borrowing, right? So let's total these two up, which is 500 million. So in terms of let me total this, yes, and I'll color blue for all the totals so it's easy to understand. And let's just put this total sign as well. So in terms of the capital structure, both the companies have 500 million, right? The total capital, but the structure is different. Company A is fully equity financed, which is their own money. Company B is 50% equity, 50% debt. So this is their own money and this is their borrowed money. So this is the scenario, right? Now let's say company B, let's put here company B pays interest. It's for sure company B has to pay interest on this debt amount. So company B pays 10%. So you borrowed 250 million from the bank, and the bank said they want, yes, we are fine to give you, provided you pay 10% interest on this value, right? So let's calculate the interest payment, right? Let's put the formula: 250 million multiplied by 10%, so that is 25 million interest payment. So company B pays 25 million interest payment on the borrowed 250 million, right? So simple and clear. So we are all on the same boat. So let's go further. Both companies pay tax, right? Both the company pays tax. At what rate? Let's say 30%. Yeah, that sounds good. 30%, fine. So, and also let's make an assumption: turnover. Company A also has 500 million turnover. Company B also has a 500 million turnover. So same turnover, right? And let's also take cost of sales. Cost of sales is 100, right? And let's get the gross profit. Right? So let me just put a total sign here and blue color. Let me get the gross profit. So turnover minus your cost, sales minus cost, is your gross profit. Let's drag this. Fine. So simple. Turnover 500 million, 500 million. Both the companies' cost of sales also same. They're making a decent gross profit. So it's fine, not a problem. And let's say the company has operating expenses as well, because companies incur operating expenses to run the business for day-to-day operational expenses, right? So operating expenses. So let's say operating expenses is about 200 million for a company, for each companies. So still there's no difference. Still both the companies seems to be okay, except here there is a debt financing and they're paying an interest. Let's keep that in mind. So operating expenses is 200 million, right? And also we also have another line item, which is debt interest. This is where the things started to change. Things are a bit different here. Now you can see the difference, right? So debt interest, obviously the company A is not paying any interest at all, because the company is using the entire equity financing. It doesn't have any borrowed money in the company, so it's zero. It's not paying any interest. But company B pays interest, right? Company B pays an interest of how much? 25 million. So we are going to put that 25 million here, which is an expense to the company. So let's calculate. Let's put the blue color sign. So profit before tax, or you can call it PBT, or profit before tax. So what is your profit before tax is, let's say, two operating expenses. Let's get your gross profit minus your operating expense of 200, because there's no debt interest. It says it comes to 200 profit before tax. So let's total up the gross profit here, minus the 200, minus the debt interest. This is where the things started to change. You see here the company A, you might see the company A is profitable, but let me show you down the line which is more profitable, right? So here company A makes a profit before tax of 200 million, but company B makes a profit of 175 million. So actually the company B makes 25 million less compared to company A, because company B pays 25 million interest for the borrowed debt of 250 million at 10% interest rate. So which is an agreeable fact. But let me go even more down to the statement. So we also have tax. How much are we paying? 30%. So let's get the tax figures, right? 200 into 30%, that's 60. Again, how much the tax for company B? So we get 175 into 30%, right? You see here, this is very important to notice, right? Let me put the tax in red color. This is the tax, and white font. So this is the tax, right? See, also let me get the profit after tax, right? As you can see, the company A pays a tax of 60 million, whereas company B pays a tax of 52.50. This is the tax savings for company B. This is very similar thing, right? Because the company B pays interest on its borrowed money. So because of the interest payment, your tax is deducted, right? Your profit is legally reduced by 25 million here because you pay interest. So since you are having a lower profit, your tax rate comes down to 52.50 compared to the 60. There's a clear saving. Let me see how much is the savings, right? You are saving tax in compared to company B of 7.5 million. That's a lot of money. This is because, you see, end of the day, you both have the same capital, right? You guys are doing very well, but company B has a slightly an advantage because the company B pays an interest of 25 million. Your profit is legally reduced, not by manipulation, to 175, and you enjoy a tax savings of 750, which is very good. So let's get the profit after tax as well. So you got your profit before tax minus 60. So that's 140 profit after tax at this scenario. Let's get company B. 52. Company B has a 122.5. So this is the profit after tax, right? This is the profit after tax. This is your final figure, right? Let me make it bold, right? So this is the situation. So if you are an outside investor, if you were to choose between company A and company B, which investment would you select? Just pause the video, just pause it at this stage, and then work out your figures. Work out and see which investment you would really, which company do you really invest on your money on as a shareholder or an investor. So just pause it for 5 minutes and do your calculation and see, right? So let me just see, as an investor, how would I look this scenario is, let me get the ROE, that's the return on equity. Let me calculate my ROE, right? If I calculate my ROE, right, which is the net profit or net profit divided by the shareholders funds. So that's the formula. So we get the net profit, right, divided by the shareholders funds into 100, right? That's 28%, which is not bad, right? Which is not bad, 28%, right? And let me get the ROE. ROE is a ROE, return on equity. So ROE is how much the shareholders are earning for their capital invested, right? Let me get the ROE for the company B. So net profit divided by the shareholders funds, which is 500. Sorry, let me just get it. Divided by so this is 28% here, right? In the case of company B, 122.50 divided by 500, right? Right? So company B, 122.50 divided by the shareholders funds. So shareholders funds is how much? Is it 500? 250? The shareholders fund is 250. That's the equity. That's the money the shareholders or you put in the business, right? You don't want to take the total 500 because this is debt. So net profit divided by the shareholders funds is 49%. That before it looked like let me multiply by 100. That's 49%, guys, right? So if you were to look at the return on equity, the return that the shareholders are getting for the capital invested, see company A invests 500, right? Company A invests 500 and gets a return of 28%, right, as a equity. Company B puts in money of 250 million rupees, which is almost 50% of this, but they make a return on equity of 49%, which is almost it's remarkable when looking at this. See, this is where the things you need to look at the company from a financial perspective if you're going to invest on this company, right? But there's one thing that you have to notice. See, this 28% is a shareholders earning. This is 49% is a shareholders earning, right? See, 28% at this stage, company A has only a business risk, right? Business risk means let's say if these two companies are hotel industries, company A is a hotel, company B is also a hotel. So business risk means if there is a COVID again, right? If there is another pandemic, the business is very volatile. The business might completely go down, and it might completely affect the profits of the company. So this 28% can be very low, but if the tourism increases, if there is no pandemic in the coming years, this figure might even rise. So there is always a business risk. Business can go wrong, but on company B, there is the same risk as well, because they are also in the hotel trade, business risk. So there is a business risk here as well. But this 49% does come with another risk. That definitely that comes with another risk called financial risk. Financial risk. So this is the two scenarios that we are looking at. Financial risk. See, this is the thing that both businesses share in common. Business can go down. Company A can lose business. Company B also can lose business. But company B additionally bears a financial risk. The shareholders in company B undertakes a business risk and a financial risk. That's why the return comes with the cost of financial risk. What is the financial risk? Because you are also operating your business on debt, $250 million dollars, and you're paying an interest of 25 million. In case in the event of loss of business, if your profit after tax cannot meet the interest payment, if your business cannot meet your interest payment, it's going to be riskier. Because if you do not have money in the business to pay the interest or the debt that you have borrowed from the bank, it's a very financial risk. So this is totally it depends on the situation and depends on the business. So it is your decision to look at it from a different perspective. If you want to invest on this business, 28%, but here there is a higher risk and a higher financial risk and a business risk, but the return is 49%. So let's even look this business even more deeper, right? Let's, before we go and put our money on this business, let's look at this business even differently from a financial perspective, right? Let's go and calculate where's the interest, 25 million, right? Let's calculate the interest cover ratio. Interest cover ratio, right? Interest cover. So the formula is profit before interest and tax, right? Profit before interest and tax divided by interest, right? So we are going to take profit before interest and tax, right? 200 million, right? Where is that? Profit before interest of tax. Let me find it. Profit before tax. Profit before tax is 200, right? So 200 million, right? Where is it? Yeah, here. This is operating expenses, right? Let me make this clear. This can also be called as PBIT, right? Profit before interest and tax, right? Before these two are deducted, right? Operating profit. So we are going to take the profit before interest and tax of company B, because we are mostly interested in this company. So we are going to even dig deeper. So profit before interest and tax divided by the interest. Simple formula, guys. Profit before interest and tax divided by the interest that you are paying for your debt. So you get a number called 8. What is this 8? So we can even write here times covered. So what does this 8 say? This 8 is a, this answer is a very useful result. This is a very useful result. This says that the company has a interest coverage of 8 times. The company has the financial capability to pay this 25 million 8 times, right? So with this profit, the company has the power, right, to pay the interest 8 times, which is very good. So the company is what do you call, the interest coverage is really good. Let's even look at more what do you call, more deeper, right? So I don't mind if I don't mind investing in company B if there is a 8 times interest coverage. If something goes wrong, maybe one time the company can pay off the interest, so still we got 7 times more for the interest. So there's 8 times backup coverage. So the interest coverage ratios tells us how many times the company can pay off the interest in the event of business risk or financial risk, right? Next, let's calculate something called debt to equity. Debt to equity, right? So this is a very simple formula, guys. You take the debt, which is 250, and divided by 250, debt over equity, debt divided by equity. So you get 1. So what does this 1 tells us? So you can even put as, you can even type it as, you can even put it as, 1 is to 1. If you want, you can put it this way, 1 is to 1, right? So this tells us that how the capital structure of the company is formed. This tells us the company has a company has financed the business from both equity and as well as debt. So the company's capital is equal to the company's liabilities. So 1:1 is not a bad as you can see 250, which is not a bad figure, right? And also we can look at gearing. Gearing is a gearing level. Gearing level shows how much of how many percentage of the company is debt financed. How many percentage of the company is running on debt, right? Which is very important, right? So we are going to get the formula. What is the formula? Is we are going to get debt right, divided by debt plus equity, which is 500, right? And we are going to multiply it by 100, 50%. So this says 50% of the company is funded by debt and 50% is equity financed, capital finance. You can very clearly see, you don't have to calculate this, right? This is the gearing level. So you can easily see 500 is the total capital. Out of that 50% is 250. So 50% of the company is running on debt financing. It's from borrowed money from external financing, right? So this is the whole scenario, guys. I don't mind. So when I look at the interest coverage, when I look at the debt to equity, so which is 50% gearing, and return of 49%, I don't mind investing on company B. So as an investor, I would try my luck on company B because it has a 49% return. But see, like if we don't dig deeper into a company, you will not know what is the reality of this investment. So if you are looking on the surface from here, you say, okay, company B has a 500 equity, 100% ownership, but this is like borrowed money and half is the owner's money. You might have a bit of a confusion, but when you dig deeper into finance, you know that there is a chance that this company is making profits. It doesn't matter you borrow money, or it doesn't matter you 100% invest. End of the day, if you can manage your finance and make a return, that's where the catch is. So this is a free advice for you guys. It's a free class for you guys to it's a free coaching, I would say, for you guys to educate yourselves if you are beginning trading or if you are beginning investing. So this is just a trading, guys, right? So let me take you guys on other let me take you more even deeper, right? So we have a debt interest, as we clearly debt interest, right, of 25 million, which we calculated before. Because we are paying 25 million, we were able to reduce the tax. So I said tax savings was how much was the tax savings? 7.5. So company A pays 60, we pay 72 because we reduced the profit by 25 million. So we are saving tax of how much? 7.5. So that's a clear tax savings, right? So if you look at so this is the tax savings you get, right? If you look at the net interest cost, you're not paying 25 million, right? Net interest cost, you're not paying 25 million to the bank. You are paying 25 million minus 7.5. So your net interest cost is 17.5, which is, guys, if you really look into this, this is a worthwhile investment, because this 25 millions on the surface is just, but since you're getting a tax savings, your debt interest is not 25. You're reducing your savings from your tax 7.5. End of the day, your net interest cost is 7.5, and it's not 10%. This is not the accurate rate that you're paying. So how much you're paying? Let me see. So let's get the exact rate. So we are going to get 17.5, which is the net interest cost, divided by how much you borrowed, 250 million. Guys, 7%. So 7% is the actual interest that you are paying on the borrowed loan. We can call this as what do you call? We can call this as post tax cost of debt. So guys, before you invest on a company, you guys have to have a lot of marketing information, and you guys need to educate yourself on finance. So end of the day, the company is only paying 7% on the 250 million, even though it looks like 10% because of the tax savings. So guys, this is an ideal scenario. I don't know how or who else can explain this situation on a better way. So this is I would say this is the best that I can give you guys. So there's always more things coming up, guys. So if you really like this video, guys, please do give me a like and subscribe. And there's always something to learn from this channel, guys. And take this as a lesson. You can replay this video over and over again, and you will find the logic, the rationale behind the numbers, right? And if you have any questions related to this, guys, please leave leave a comment on the description, and I'll try to save this workings and leave the link on the description below, guys. Alright, thanks for watching, guys, and I hope you guys are having a lovely day.